This is Al Brooks, and this is my price action trading course. This module is entitled How to Trade. As a trader, you have to have goals. For me, my number one goal is to follow my rules. My next most important goal is not to lose money. To me, that's far more important than making money. I want to make sure that I'm doing the right thing and that I do not lose money except when I'm doing the right thing. I certainly don't want to do things that will cause me to lose money. Next, I want to make money. Obviously, everyone wants to make money as a trader. And my least important goal is to make a lot of money. Some days I do make a lot of money, but I don't try hard to make a lot of money. What I try hard to do is make money, and sometimes I'm fortunate and I make a lot. I'm much more concerned about following my rules, doing the right thing, not making stupid mistakes. And if I do that, I will make money, and sometimes I'll make a lot of money. If I focus too much on making a lot of money, I'll end up losing money. So to me, the most important thing is try to stay objective and do the right thing, and that gives you your best chance of making money. If you want to make a lot of money, you're probably feeling greedy, and you're being influenced by emotion, and you'll have a hard time following your rules and achieving your goals. You'll end up losing. What's the big picture? In trading, it's actually fairly simple. You buy at support and you sell at resistance. If you're long, you wait for a rally up to a resistance level, and you start to scale out of profits, and that creates a small pullback. If the market goes higher to another resistance level, you continue to sell out. If you're short and the market is going down, you're going to buy at a support level. And if you're flat and the market goes down to support, you look to buy. If you're flat and the market goes up to resistance, you look to sell. It's no secret. Just turn on television and look at Fast Money, Options Action, Money in Motion, Fox Business News, CNBC, and listen to traders. That's all they do all day long is talk about, the market is coming down to a support level, or a gap down, but it's right at a support level. I think I'll buy. Or, we had this big bear breakout and now we're rallying, but it's testing the breakout point. I think I'll sell. You don't hear them saying, there's a dark cloud cover or a morning star or a Harami pattern. They're not talking about candle patterns. They're talking about support and resistance. Sometimes you'll also hear them talk about, the market is really strong. I'm going to buy, or I'm going to buy calls. The bull market, the market's racing up. So in other words, they see the market as in being in a bull breakout, and they buy. And they don't sell out at resistance because they assume resistance will fail. And they look for any reason to buy. They'll buy at the market. They'll buy a strong bear bar. They'll buy a strong bull bar. They don't care. They just know the market is going up and it probably will be higher, so they're going to buy. And in a strong bear breakout, they don't pay attention to candle patterns. They're going to sell because they know the market is going lower, or they feel strongly that it will, and they believe that all support will fail and that the market will just continue lower and lower and lower. And they'll look for any reason to get short, and you will never hear them, or only rarely ever hear them, talk about a candle pattern. So the context, where we are in the market cycle, the strength of the market, all the bars to the left, that's much more important than the candle patterns. Management is the key. You're buying at support, you're selling at resistance most of the time. During the strong breakout phases, which happen maybe 5% of the time, you're trying to get in the market immediately for any reason. If the risk is big, let's say the market's in a strong bull breakout, and you see that the stop has to be far below where the market currently is, and you're afraid of taking a long, either you trade very, very small, or you use options. Options are an alternative to a very wide stop because your risk is contained. Also, sometimes you'll hear traders who are long on television, and the market has gone a long way, and the logical stop is far below, and they don't want to risk that much. So they'll replace their stock position with options. So they'll sell out of their stocks, take their profits, and then buy a call or buy a call spread because they don't want to risk to where they have to risk given how far away the logical stop is, let's say the most recent higher low. Beginners always want trading to be easy. Al, why can't you tell me what the perfect trade is? Why can't you tell me the perfect setup? I want to make money. I'm willing to work really hard. I'm willing to study. I deserve to make money. But it's not. What beginners fail to realize is that there are institutions on both sides of the market at all times. For you to be able to buy, an institution has to sell it to you. For you to be able to sell, an institution has to be able to buy the other side. And both the bull and bear institutions are profitable. And they're making. How can both make money if one side's buying and the other side's selling? There are lots of ways, but it all comes down to management. So, for example, if you're buying and a bear institution is selling, they might be willing to sell in more higher. They might be willing to scale in. They might be hedging and offsetting the position in another market. You just don't know. The bottom line is it's not going to be easy. Trading is always going to be hard because you're trying to take money from institutions, and the institutions are profitable, and there are institutions on both sides. So the margin is always going to be small. Beginners want an edge. They want to be able to buy some magical signal that's going to work all the time, or a very high percentage of the time, with very little risk. But if you think about it, if you're going to be able to buy with potential for a huge reward and very small risk and a high probability of success, there has to be an institution willing to take the opposite side of the trade. And the institution won't do it. And because there's no institution who will take the other side of your trade and willingly give you money, your perfect trade cannot exist. Also, traders feel like everything that they've done in life, if they work hard, they get paid. And if they work hard, they deserve to be paid here as well. Let's say they're a furniture maker and they make a chair, they get paid. If they make 10 chairs, they get paid 10 times as much for all their hard work. But that's not how the market is. You don't get paid simply because you work hard. So you can study all you want. You can learn candle patterns as much as you want. You can force yourself to be as disciplined as you want, but you don't deserve to get paid. It's like a 40-year-old baseball pitcher who made a fortune through his career, and now his 90-mile-an-hour fastball is down to 84 miles an hour, and batters just hit him like crazy. That 40-year-old pitcher can work as hard as he wants, but he's no longer going to get paid, because that's the nature of the business. And trading is the same way. You don't get paid for hard work. You get paid for being good. Life is not fair. You can look at people on television who appear to be rich. You can listen to people say Goldman Sachs makes a lot of money, or hedge funds make a lot of money, and therefore I deserve to make a lot of money. I'm a human being. I have the same basic human rights. I deserve to make money too, especially if I'm willing to work hard. But that is not true. You don't deserve anything in trading. Nobody does. And Goldman Sachs, they're as good as their last trade. If they start to lose, trade after trade after trade, they'll go out of business. Again, as I said, perfect trades do not exist. Beginners always want them. People are always asking me, Al, what's the best setup? There is no best setup. Look at the charts. The market is trading all day long, and that means institutions are buying and selling all day long. You make money by doing what they're doing. So you look to buy and you look to sell all day long. And you just try to find setups where there's an edge, where you have some advantage, where you can structure the trade and manage the trade in a way that will likely result in you being profitable. But even at your best, your edge is going to be small. So first of all, you have to get good enough so you have an edge, a mathematical advantage, a mathematical likelihood that if you do what you're doing 100 times, you'll end up with a profit. And your edge can come from taking low probability trades. So you can be right 40% of the time and lose 60% of the time and still make money if your system results in taking winners that are several times greater than your losers. Candlestick patterns, I think they're a fraud. I was looking at the internet the other day and Google searching how to trade to get ideas about what my competition is doing in terms of courses, and it looks like everyone is pushing candlestick patterns, and it's as if that's the way to make money, and it's not. Look at traders on television. When's the last time you heard a trader talk about a candlestick pattern? They don't talk about them. Goldman Sachs and hedge funds, they're not using candlestick patterns. High-frequency trading firms, they're using tick charts. They don't even see candlestick patterns. Candlestick patterns are being sold by false prophets as a means of taking you to trading heaven, and that's just not the case. They give you false hope, and that is not how traders make money. A setup is composed of two things: a candlestick pattern, in other words, a signal bar, or a signal collection of bars, and a context. Context is everything to the left, and that is far more important than the signal bar. For example, if the market's in an extremely strong bull trend, it doesn't matter what the candlestick pattern shows. You're going to buy. If it's a strong bear bar, you're going to buy. If it's a strong bull bar, you're going to buy. If it's a weak bull bar or a weak bear bar, you're going to buy. The context overwhelms the candlestick pattern. On the other hand, if it's in a pretty strong bull trend and you're looking to sell, you only want to sell if you see a very strong bear reversal bar. Most of the time, starting out, you should not be giving any thought to selling in a strong bull trend or buying in a strong bear trend. You'll lose money. Trading, it takes years to get good, and you will lose money for years. Most traders lose forever. However, we're all attracted by the lure of making a lot of money and being able to get a multiplier effect. When I was an eye surgeon, I could do one operation at a time. I could not do 10 or 100 at a time. As a trader, I can trade one contract, but I can also trade 10 contracts or 100 contracts. And everyone is intrigued and lured by the possibility of becoming rich. And that's why we're all here. It's fun, and the upside is huge, and we want to find out if we can do it. We know that people do it. Goldman Sachs, hedge funds, a lot of them are very rich, and that's why we're all here. We all are attracted to the possibility that we can figure it out well enough to become billionaires. And that's okay. But you have to remember that everyone loses for years, and that most traders who try this end up losing forever. And if you're looking for perfect trades and profits to take you to salvation, you will lose. The only way to win is by doing it yourself. Learning enough to do it. Learning some successful systems, and being disciplined and doing the right thing day after day. The market's in a never-ending cycle. It's either in a trend or a trading range. And when it's in a trend, it becomes a trading range. And when it's in a trading range, it becomes a trend. Trends happen in two ways. There's a spike phase, the breakout phase, the strong trend phase. That gives way to some two-sided trading, and then the market's clearly in a channel. The channel becomes increasingly two-sided, increasingly flat, and part of a trading range. And once it's in a trading range, it's in breakout mode, and it can break out in either direction, and then the process begins all over again with another trend breakout. You have to pay attention to the type of market that you have, where you are in the market cycle. So if you look at the chart and it's in a trend, you need to know whether it's a strong trend, in other words a breakout, or a weak trend, in other words a channel, and you trade them differently. And if it's not in a trend, then it's in a trading range, and that also has its own characteristics, and you trade it differently from how you trade a trend. So here's an example of the market cycle. The green boxes are trading ranges, and trading ranges can break out in either direction. For example, here's a trading range. In a bear trend, it broke to the downside, but the breakout failed and it reversed up. Here's a trading range in a bull trend, and it broke to the upside. Here's another trading range in a bull trend, and it broke to the downside. So trading ranges can break out in either direction, and when they do break out, they can sometimes reverse. The pink box, that's an example of a strong bull trend, a breakout phase. Right here, I don't have it in pink, but that's another example of a breakout phase. The red lines, they highlight the channel phase of a trend, where the markets become more two-sided. There's overlap. There's some bear bars in a bull trend, some pullbacks. And channels eventually evolve into trading ranges. Within a channel, there are pullbacks, which are very small trading ranges. On smaller time frame charts, that is a trading range. A pullback is simply a small trading range, but unlike other trading ranges where you don't know the direction of the breakout, a pullback occurs in a channel within a trend, and the odds are high that it will break out in the direction of a trend. All trends have some element of spike and channel to them. Here's the spike phase of the trend, and it's usually followed by the channel phase of a trend. And channels usually evolve into trading ranges. When you look at the entire screen, it's a trading range. But if you only look at the chart through bar 10, it's a trend. So yes, in the move from 5 to 10, it's in a bull channel and a bull trend. But later on, when you're over here at bar 18, you would say that the trading range began maybe at bar 4 or maybe at bar 5. So the move from 5 to 10 is a bull trend, it's a bull channel, but it's also part of a trading range. And after the market's been in a trading range for a while, it breaks out again into a trend. Each blue box is a breakout phase of a trend, and the space between the red lines is a channel phase of a trend. So you have a breakout and then a channel, a bear breakout and a bear channel, bull breakout and a bull channel. It's important to know where you are in the market cycle, because each part of the cycle offers different trading opportunities. And if you know where you are in the cycle, you can fall back on trades that are appropriate for the current market condition, a breakout, a channel, or a trading range. New traders sometimes worry all day long about capturing the absolute best signal of the day. On the spider chart, there are 78 bars in the day, and sometimes the best signal occurs once on one of the 78 bars. And if you don't happen to be at your computer at that moment for any reason, or if you see it and you feel like you're pressured to make a decision whether or not to enter, and you choose not to enter, beginners sometimes feel bad that they missed the best setup. That was the opportunity where the reward was the greatest and the risk was the least and the probability was good, and they feel bad. But it does not matter, because as long as you understand what the market is doing, you can make profitable trades in any part of the market cycle. And I have modules about trading every part of the cycle. So for example, you can capture a reversal. If you don't capture the reversal trade, let's say a bottom, and the market starts to rally strongly, the market becomes always in long, it's in a breakout phase, then you can enter during the breakout phase. There are many good ways to enter during breakouts. Once the market starts having pullbacks, you can enter during the pullbacks. Once it starts to channel, you can enter during the channel. During the breakout phase, you go for swing trades. When it starts to channel, you can swing trade at first, but later in the channel, you go for scalps. When it enters a trading range phase, you start to buy low, sell high, and scalp, and then you wait for the next breakout. So you can trade at any part of the market cycle, and it does not matter if you miss the very first part of a new leg up or down, because you can enter at any point as long as you understand how to trade. I have modules that address trading at every part of the market cycle. Here's an example. So the spider 5-minute chart, the market gapped down and then it traded down a little bit. You could draw a trend line through here, a little bit of a breakout, did not reach the moving average, arguably a higher low major trend reversal. So here's the bear channel and the trend line break, about 5 to 10 bars sideways, and then 2 or 3 legs down, push down here, reversed up, more buying pressure, push down here, more buying pressure. So look what's happening after the bear bars. We tried to break to a new low, bull bar, 2-bar reversal. Tried to sell off, bull bar. Tried to sell off, bull bar. Tried to sell off, bull bar. Right? So the bears are obviously no longer able to generate consecutive trend bars as they were on the open. So the bears are clearly weakening, and we're transitioning into a two-sided market. Here you have a possibility of a breakout of the bear channel and a higher low major trend reversal and a very good looking signal bar, an IOI pattern with the bull bar closing near its high. You could also call it a head and shoulders top. So this technically or arguably is the best entry of the day. It could be the low of the day. We could be at the beginning of a bull trend. The setup is good, so the probability might be 55-60%, and the risk is small because the signal bar is small. So if you were who knows, on the phone with one of your kids and you did not take that trade, don't get depressed. By the time this bar forms, this big bull breakout bar, now we have 4 consecutive bull bars, a close above the trading range, a close above the moving average, and we have a higher low major trend reversal signal. Most traders at this point think the market is always in long. So what do? You go to the module on how to trade bull breakouts, strong bull trends, and it'll tell you. And one thing you can do is simply buy at the market. We have an II pause with a bull bar closing on its high tick. You can buy there. We have another breakout. We can buy here. You can buy anywhere in here. You could buy a high 2 buy, high 1, high 2. You could buy that. A larger two-legged move down, 1, 2, a bull inside bar. You can buy that. Follow through after the bull bar. You can buy above its high. Wedge top up here. One push up. Here's a bull spike. Second push, third push. You could, and a good-looking bear bar. You could sell that. The market's selling off for 3 bars, and the context is good for a pullback. We have a wedge top, so we should get 2 legs sideways to down. We have a good-looking bear bar closing on its low tick. We have 4 consecutive bear bars. Aggressive traders will place limit orders to sell above the high of the prior bar, looking for 2 legs down. Channel down, very, very tight with dojis. To me, this is probably the first of 2 legs down. The market went up, down, up, so there's a low 2 short either below here or below this bar. And, I personally would not take it. I think the day's a trading range day, and we're getting low in the day. I would only look to buy. But, once in here, if you wanted, you could trade it as a trading range. I think, in general, at the start of the day, it's better to wait for a swing setup. So it's probably better for most traders not to begin trading until this point. However, if you missed that great entry, there were many other opportunities to make money all the way up, and then you could make money on the way down as well. So it does not matter if you miss this. Yes, it probably was the single best trade of the day, but there were many other very good trades. And you can make a living looking for the best trade of the day, but if you understand the market cycle and where you are in the market cycle, there are many other opportunities to profit, and you don't need to capture the best one every day. I usually use binary decisions to decide. I'm always trying to make my decisions easier, and if I can structure the decision so that there are only 2 choices, then I have a binary decision, and it requires less thought. For example, is the market in a trend or a trading range? Here's an example. If the market's going up, is it going up in a bull trend, or is it going up in a bull leg within a trading range? And if I can clearly answer the question, I trade appropriately, either a trading range or a bull trend. If I cannot clearly answer the question, in this particular case, I assume it's a trading range. So if the market's going up and it's in a bull trend, I'm only looking to buy, and I'm going to try to swing at least part, maybe the entire position. If, on the other hand, I think the market's in a bull leg in a trading range, I'm only going to take buy signals, and I will consider strong sell signals near the top of the range, especially if they're second entry shorts, and I'll only scalp. I want to buy low, sell high, and scalp. So near the top of the range, I'm looking to sell, but I'm only scalping. And near the bottom of the range, I'm only looking to buy, and again, only scalping. So if the trend is a strong trend, if I look at it and say, wow, that's strong, then it's in the breakout phase also the spike phase, and I know that I need to get long immediately. And if I don't see an easy signal to allow me to enter, I buy at least a small position at the market. Now, if the market's going up, a bull trend, the initial stop is below the bottom of the spike. So if I'm buying way up above the bottom of the spike, my stop is wide, so I have to trade small, at least initially. And then if I get a pullback or other signals, I can build my position as the market goes up. If I look at the trend and it doesn't look all that strong, then it's a weak bull trend, right? And a weak bull trend is a channel. If the channel is extremely tight with very little overlap and very few bear bars, then it's essentially a breakout, and it certainly is a breakout on a higher time frame chart. So I trade it like a strong bull trend, even though it's a channel. If it's a broad channel with big swings up and down, especially if it's very flat, and it's almost like a trading range that has a slight upward slope to it, I certainly take the buy signals because it's a channel and a bull, so it's a bull trend. But if the swings are big, I can sometimes take trades in both directions and trade it like I do a trading range: buy low, sell high, and scalp. If the market's going down, again, I try to structure a binary decision. Is it clearly in a bear trend, or is it probably in a bear leg in a trading range? If it's clearly a bear trend, I only want to sell, and I want to swing at least part of my position. On the other hand, if I think it's a bear leg in a trading range, I look to take sell signals for sure because it's a bear leg, and I'll take strong buy signals near the bottom, especially if they're second entry buy setups, and I'll only scalp. Bear leg in a trading range, if it looks like the market's in a trading range, in other words, if the market has been swinging up and down, and the current leg seems to have weakness as it's forming. So as the market's going down, it has a bear bar and then a bull bar, a bear bar and a bull bar, a bear bar and a bull bar. So if there's a lot of buying pressure in the leg as the leg is going down, and the leg is still within the bars to the left on the chart, it's more likely a bear leg in a trading range rather than a bear leg in a strong bear trend. Okay, if I look at the bear trend and it looks strong, it's in the breakout phase, it's spike phase. Breakout, spike, same thing. I need to get short immediately. I either sell at the market or I wait for a bear bar to close near its low, and I sell that bar. And in any case, I want to get short at least part, because if I wait for a pullback, the market may drop 5 or 6 bars and go way down before there's ever a pullback, and I don't want to miss the entire trend. Since my stop goes above the top of the bear spike, which can be far away, my initial entry will be small. Once I decide it's in a bear trend, I need to know if it's in a weak bear trend. In other words, is there a lot of two-sided trading and some buying pressure? If it is, then it's in a channel. If the channel is very tight with no bull bars and no pullbacks or only minimal pullbacks, then I trade it like a breakout, like a strong bear trend, and I only look to sell. On the other hand, if it's going down with swings up and down, and it's almost like a trading range that has a slight downward slope to it, I'll trade it like a trading range and take trades in both directions: buy low, sell high, and scalp. But since it's a trend, lower highs and lower lows, I want to make sure that I take the sell signals. The buy signals are optional, and I only take them if the setup is strong. Who's in control of the market at any given time? If you look at the market and you had to get in the market, either long or short, if someone said you have to do it, you have to buy or you have to sell, whichever trade you make is the always in direction, always in long or always in short. And if the answer is clear, then you only want to take trades in the direction of the always in condition. So if you look at the market and say, yeah, if I had to be in the market, I definitely would be long, then only take buy signals. Okay? And one way to tell who's in control is to learn how to spot buying and selling pressure. I have a module earlier on that talks about the footprints of buying pressure and selling pressure. And that's the single easiest way to tell if the market's always in long or short. If there's much more buying pressure, it's always in long, and it probably will go higher. If there's a lot of selling pressure, it's always in short, and the market probably will fall. Perfect trades, okay, they cannot exist. The market lives in the band of 40 to 60% probability. Nothing is more than 60% certain. Nothing is less than 40% certain. Because beyond that band, there won't be anyone to take the other side of the trade. Remember, you have to have institutions taking both sides of the trade. And because the institutions are basically, you have to assume they're all profitable, the band is going to be tight. Probabilities cannot get too extreme one way or the other. Beginners are always looking for guarantees and perfect trades. Tell me a signal that works all the time or 90% of the time. I don't want to lose money. You got to tell me something that works. And if you don't do that, what good are you? That's not the way the world works. The institutions control the market, and the bears and bulls both make money. And for that to happen, the edge for both sides has to always be small, and the probability has to be in a very small band. And the result is perfect trades cannot exist. You're living in a world of uncertainty. A lot of times it's hard to tell where you are in that 40 to 60% band. And, that's just the nature of trading. You're never going to be certain about anything. However, if you can make the math work out, then you can still take trades. Even if you're only 40 to 50% certain that a trade is good, you can still make money based on the trader's equation if you go for a reward that's at least twice as big as your risk. So only 40% chance of being successful. If you go for a reward twice your risk, you're going to make money. If you want to scalp and take a small profit, you need at least a 60% probability of being successful. So, for example, if you're in a strong bull spike, you see how far away your stop has to be. If you go for a reward equal to the size of that stop, 60% trade, you will make money, even though your reward is only as big as your stop and not 2 times or 3 times bigger than your stop. Beginners are always waiting for the perfect setup. So they wait until they're very confident of the trend. So they see a big bull bar, another big bull bar, another big bull bar, and they say, yeah, it's going up. And then another big bull bar, and then a smaller bull bar, a smaller bull bar, and another big bull bar. And they're saying, yeah, it's definitely going up. I know it's going up, and I don't want to risk all the way to the bottom of the spike or even halfway to the bottom of the spike. That's just too much risk. I'm going to wait for a pullback. So they end up missing the entire breakout phase of the trend when the market runs many, many points in a very limited period of time. And then the market suddenly starts to pull back. And they look at the pullback and they say, wow, that's a buy climax. I think the market's going to reverse and fall very, very far. So as the market's pulling back, they'll get a high 1 buy setup. They don't take it. The market goes up. They get a high 2 buy setup. Oh, this time it's going to reverse for sure. And they don't take it, and the market goes up. So they end up missing the trend, the spike phase. They end up missing the channel phase and the pullbacks along the way. And they end up missing the entire trend. Very often, by the time the beginners see the market as being in a trend, the stop is very far away. That's okay. You just determine the size that you would have to have for your stop. So if you normally use a 2-point stop, and now the stop has to be 5 points away, for example, the bottom of a very strong bull spike, just reduce your position size. Take a 1/3 size position. And mathematically, that is a very good thing to do. You have to get market when it's in a strong trend, even if you're trading very small. And you can always build your position to a full size later on. So let's say you're shorting in a very strong bear spike. You sell at the market, and you hold short, and then you're trading small, and then the market starts to pull back, but you're confident it's going to go lower. You continue to hold your swing portion, and then you can add a scalp portion in as well. And then on the move down, you can scalp out the scalp portion, but continue to hold your swing. Being patient has 2 parts to it. One is being patient while you wait for a good setup, and the other is being patient when you're in a good trade and make sure that you hold it for enough of a reward. Don't scalp out early. It's hard to hold as the trend constantly tries to reverse. All trends are always trying to reverse. But you have to learn to rely on your stop and on your read. When you look at the chart, even though it's starting to channel up, it's still a trend. Learn to rely on your stop. Put it below the most recent high or low, and just hold until the market appears to be transitioning into a trading range. So don't scalp when you should be swinging. So when there's clearly a trend, make sure to swing at least part. The profits in a trend end up being much larger than what seems possible at the time that you put the trade on. Remember the trader's equation. You only take a trade if the probability of success times the reward is greater than the probability of failure times the risk. And the probabilities are always between 40 and 60%. And at least that's the assumption you should make. The reward, that's where you set your profit target. So you always know the reward. The risk, that's how far away you put your stop. You always know the risk. What you don't know is the probability. And if you look at the market and you say, yeah, it's probably good, assume the probability is 60%. If you look at it and you say, oh, I don't think this is going to work, assume the probability is 40%. And if it's 40%, you have to go for a reward that's at least twice your risk. So you know your risk, you know where your stop has to be. If you think the trade doesn't look all that good, assume 40% probability. Then you have to go for a reward that's at least twice as big as your risk. So just place your profit-taking limit order 2 times the number of ticks away from your entry price, as is your stop. Probability is the most important variable in the trader's equation because it's the only one that you cannot control. You determine the risk, you determine the reward. The probability you don't know. Probability is the reason why it's so hard to make money, but management is the key to success. Probability, the uncertainty inherent in all trading, it makes beginners not take potentially great trades, and it makes them exit strong trades way too early. They're so happy to finally have a profit that they just grab it, and they end up leaving a much larger profit on the table. Probability is the source of all emotion. There's no emotion to setting your stop. You just look at it, you know where it is. There's no emotion setting your profit-taking limit order. It's either 1 or 2 times your stop distance, or a swing and you just let it go. The only reason people have emotion in trading is because of probability. Computers, they don't have emotion. And you can only make money if you follow what the computers are doing. So if you're making judgments based upon emotion, you're not following what the computers are doing, and you will lose money. So emotion creates losers, and you'll lose until you learn how to be free of your emotion, and you cannot win until you're comfortable with constant uncertainty. You're always going to be uncertain, and that's just the nature of the market. There has to be someone, an institution, taking the opposite side of your trade, and they would not do it if they were certainly going to lose. So you're always going to be placing trades when you feel the probability is never as good as you want it to be. I mentioned this before. Traders swim in a sea of constant uncertainty. In clarity, it exists only briefly during strong breakouts. Most of the time, trading is unclear, and rarely is it more than 60% certain. So if you're going to be a trader, these are realities that you have to accept because they're real. I mean, this is our life. Beginners always want perfect trades, but they simply can't exist. You just have to accept that you'll be wrong 40 to 60% of the time, and you'll be right 40 to 60% of the time. And if you manage your trades properly, setting your reward and your risk correctly, you can make money doing this. You have to remember the 60-40 rule. That is that most of the time the probability is between 60% and 40% that you can make a profit by either taking a long entry or by taking a short entry. And remember, if you buy, there's an institution on the other side selling, and that institution is profitable, and selling at this moment is part of their profitable strategy. If you're doing the opposite, if you're selling, there's an institution taking the opposite side of your trade that's buying, and their buying is part of a profitable strategy. So most of the time, it doesn't matter which side you pick. If the market is falling sharply, you can sell, betting it will fall more. You can buy, betting it will reverse. and it doesn't really matter. The key is trade management. Sometimes during strong breakouts, you should only be going in the direction of a breakout. Whenever there's a strong bull breakout, you should only buy, and you have to buy. Find any reason to buy. I have a module on bull breakouts that talk about the reasons. If it's in a strong bear breakout, you have to sell. If it's in a channel, let's say a bull channel, and this channel is very strong, only look to buy. Once the channel starts to weaken and get strong sell-offs along the way, you can start trading in both directions. But most of the time, you can make a case for the bulls and a case for the bears, and it's far more important how you manage the trade than it is which side you can take, which side you take. Very often, taking the 40% side is a better bet than taking the 60% side. So, for example, if the market is forming a lower high major trend reversal, the probability may only be 40% that the trade will work, and it may be 60% chance that the trade will go higher. But if the context is right, the 60% chance may be simply for a reward equal to the risk and not be very big, and the 40% may be for a reward many times greater than the risk and have a much stronger trader's equation. Let me give you an example. This slide is from the module on trading a weak bear channel, and the market is starting to form lower highs and lower lows. So it's in a bear channel. And then here, on pretty much a double bottom and a very strong bull rally. At the close of this bar, bulls will say, wow, 4 bars up, 2 of them have very big bodies. I think there'll be buyers below, and the market will continue much higher. The bears will look at the close of this bar and say, wow, what a gift. The market's making lower highs and lower lows. I like the probability of the market continuing to do so, so I'm just going to sell here at the market at this close. The bulls are buying this close, looking at it as a strong bull spike, and they're betting on the successful breakout. The bears will look at this close and say, this is great. What an opportunity to sell at an extremely high price. My risk is only to above the most recent lower high, so I'm not risking much for my entry price to the prior lower high, and my reward is at least to a new low, because if this is a bear trend that will continue, it'll form a series of lower highs and lower lows. So at any given moment, even when you see something that appears to be as strong as this is, there are bears who will sell aggressively. Likewise, the bulls will see this strength and they'll buy aggressively. In this particular case, the market continued way down and the bears won. But there may have been a 50-50 chance that the bulls could have won, in which case the bulls would have made at least 2 times their risk. Whenever the market is 50-50, you should be going for a reward twice the size of your risk, and both the bulls and the bears will do that. The bulls who bought here, their stop might be below here, might be below this bottom of the bull spike. In any case, wherever it is, they'll go for 2 times their reward. If the market starts to turn up here, they'll do their 2 times calculation based upon actual risk, their entry price, to 1 tick below the low of the pullback. So just be aware that as certain as you are of anything at any given moment, you have to remember that there are institutions who are taking the opposite side of your trade, and they have at least a 40% chance of being right. So you should always be considering both sides of a trade. For example, Nike recently had a very big gap down on earnings. And if you listen to Fast Money, they were talking about, well, should we buy this or should we sell this? And as a beginner, you might think, wait a minute, how can they be thinking about buying and thinking about selling? That doesn't make sense. It does make sense. Because if it gaps down to a magnet area, like a support area, it's a good area to buy. And if you manage your trade correctly, you can have a positive trader's equation and make money. On the other hand, the bears will argue, wow, that's a very big gap down. It probably will have good follow-through, and we'll make several times more than we stand to lose if we're wrong. And it doesn't matter what the candle pattern is. What is far more important all the time is the overall, the big picture, the context. You know, are you at support? Are you at resistance? Are there multiple levels of support? Are there multiple levels of resistance? Does the resistance appear very, very strong? Does the support appear very, very strong? Is there a good target? Let's say you take the short, is there a reasonable target that is going to pull the market down? In other words, is there a support level way below the market that might pull the trade down there so that your risk is much smaller than your reward? Likewise with the bulls. Do they have some kind of target way up here? Maybe a trend channel line drawn across these bars would project way up here. So they may be holding for a reward many times their risk. So, just be aware that at any given moment, bulls and bears are entering, and they're very smart. They're institutional. And even though it may look extremely unlikely, it's much more likely than you think. And assume 95% of the time that the probability for the bulls and for the bears is within 40 to 60%. You cannot control the probability. You're either confident, certain that the trade looks good, then assume the probability is 60%. Or you're unsure, I don't know if this looks good, then it's 50%. Or if you think, well, this probably won't work, but the reward is so much bigger than the risk, I'm going to take the trade. Then the probability is 40%. And just make a reward sufficiently bigger than the risk to turn the trader's equation positive. In general, even with a 40% probability, as long as your reward is twice your risk, you have a positive trader's equation. Again, the risk is the number of ticks to your stop. The reward is the number of ticks to your profit target. And when you're not certain, you need to set your profit target at least twice as far from your entry price as is your stop. You need a reward twice as big as your risk. You really have to learn how to manage trades well, and it's more important than spotting perfect setups. Most of the time, there's a profitable way to manage both a long and a short trade. Remember, if you buy, that means some institution sold it to you, and that institution has a way to make a profit. Otherwise, they would not sell you the other side of the trade. If you sell, that means an institution had to buy from you, and they would not be buying unless they could make money by doing it. So most of the time, there's a way to make money by either being short or being long, depending if you manage the trade correctly. An obvious way is scaling in as the trade goes against you. That's beyond, I think, the reach of most beginners. So what kind of chart should I be using? Price action techniques work on all types of charts because the movement on charts is simply a reflection of human behavior, and any chart captures that behavior. For most traders, a good starting point is a 5-minute chart, or maybe even a 15-minute chart, assuming they can trade small enough so that the increased stop size does not cause them to put too much money at risk. My rule of thumb for somebody starting out, in fact for anyone, even very experienced traders, is to avoid any chart with more than 20 bars per hour. So that would be a 3-minute chart. Most traders should not be even trading a 3-minute chart. And they certainly should not be trading a 20-tick chart or a 500 share chart or a 1-minute chart or a 2-minute chart. Why not use a small time frame? High-frequency trading computers use the smallest time frames. They use tick charts, and many of them make a lot of money. The risk is obviously very small, and if you have a winning system, why not use it 10 to 20 times a day or 50 times a day instead of just 3 or 4 or 5 times a day? You can do manual high-frequency trading. Paul Rotter does hundreds of trades an hour by hand. And there are some day trading websites that recommend trading on a 1-minute chart or a 20-tick chart in crude oil or in the currencies. This is simply manual high-frequency trading, and if your techniques are good, you can make a fortune, and that is absolutely correct. However, there's a problem. 99% of great traders cannot make money using them year after year. And if you try, your account will slowly or quickly disappear. And why is that? Why not trade on one 1-minute chart? What's the problem with a 1-minute chart? The risk is very small, And that's very appealing to beginners because their accounts are small, and the one thing they're most concerned about is risk. And if they trade a 1-minute chart, the stop is closer to their entry price, and their risk is less. And the logic is great. If you have a winning system, why not apply it 20 times, 50 times a day, 100 times a day? You'll make that much more money. Time is the problem. Deciding to take a trade takes time. Deciding how to manage your trade takes time. And our brains are not designed to make that many decisions correctly in so little time, and to make them so many times a day. I'm a very smart guy, and years ago I could trade the 1 and 2 minute chart, but it was very hard, plus it was not fun, and I was not making any more money than when I trade the 5-minute chart, because it's really hard to do. You end up cherry picking, especially after an hour or two of trading. You get tired, you lose focus, and invariably once you start to cherry pick, you'll find that you tend to pick all the bad cherries. They look great, but they tend to end up being the worst ones. The way the market is structured, it's always going to generate the most pain. So the trades that look the easiest usually are losers. And it's very hard to make the decision when you have very little time. And so if you're trading a 1-minute chart, you're giving yourself seconds by the time the bar closes to make a decision whether or not to take the trade. And it's simply not possible for 99% of successful traders to do it well, day after day, year after year. So those websites that promote that kind of trading, it sounds great, little risk, big profit. The reality is very few traders can do it successfully, for a career. We're not talking about doing it successfully for a few days or a week or even a month. We're talking about doing it for 10 years, 20 years, 30 years. And I think most traders simply cannot do that, and it's not worth it, because you can make a lot of money doing something else, and you'll enjoy what you're doing much more. What's the alternative? Well, before trying a 1-minute chart, first prove that you can be consistently profitable on a 5-minute chart. And if you can, simply work on increasing your volume, the position size. And in the end, you'll make far more money than by reducing your time frame and increasing the number of trades. Taking 5 to 10 trades a day on a 5-minute chart for most people is going to be vastly much more profitable than taking 20 or 30 trades a day on a 1-minute chart. In fact, you will lose money if you try trading 1-minute charts. Okay, where do you begin? Any trade with a positive trader's equation is a good trade. It does not matter where you are in the market cycle. Some traders prefer to trade only certain types of setups, and that's okay. If they're trading trades with positive trader's equations, they'll make money. The best place to start probably is with major trend reversals. Okay, the setup, the probability is usually between 40 and 50%. Make sure to set your reward to at least twice as big as your risk. This results in a good trader's equation, and an important factor is time. There's usually enough time to decide, and that's very important for beginners. When you enter a trade, if the goals are really not all that clear, rely on defaults. For example, you'll put an initial risk beyond the signal bar. For example, if you're buying, you put your stop below the signal bar, 1 tick below, and you take partial or full profits at twice your initial risk. And if you took partial profits, you swing the balance. In terms of scaling out, if you are trading a big enough position that would allow you to scale out, you might take half off once the profit reaches twice your initial risk, take another 25% off at 3 times your initial risk, and then swing the balance and trail the protective stop and look to exit before the end of the day if it's a day trade. Once the trade goes your way, you should look to adjust your profit targets based upon your actual risk instead of on your initial risk. So you would take half off at 2 times your actual risk, take another 25% off at 3 times your actual risk, and swing the final 25%. Once the trade goes your way, you should look to adjust your profit targets based upon your actual risk instead of on your initial risk. So you would take half off at 2 times your actual risk, take another 25% off at 3 times your actual risk, and swing the final 25%. Here's an example. We have a bear trend, a bear channel. I didn't draw the channel line in. A break of the trend line, a test of the moving average, pretty good buying pressure in the rally, and then a plunge down that immediately reversed up. You could buy above this bull bar, or you could take the second entry above this bear bar for a double bottom bull flag, or you can say it's a higher low major trend reversal where the higher low came in the form of a double bottom. It's also a triangle, 3 pushes down, 1, 2, 3. In any case, the protective stop would go below the bottom of the higher low, the big bull trend bar, and you'd go for a reward that's equal to at least twice your risk. You can just walk away if you want. Just place the orders and take a walk and come back in an hour. You know, if you can't stand watching. If you don't take the first entry, then you can always wait for the always in condition to become clear. And it always in becomes clear by either of 2 things. Either there's a strong breakout that immediately tells you the market's clearly always in long, or you have a series of consecutive trend bars. In that particular example I just showed you, if you start getting 3, 4, 5, 6 consecutive bull trend bars, traders will believe that the market's going higher, and that means they believe the always in condition is long. And therefore, if you buy anywhere as that spike is forming and put a stop below the spike, you have a 60% chance of making a reward that's at least as big as your risk. So here's that same chart. Doesn't matter. Let's say you did not buy here and you did not buy here, and you see it's a potential higher low major trend reversal, and now we have 4 consecutive bull bars. And not only 4 consecutive bull bars, there's good buying pressure. The close of this bar is above the high of this bar. The low of the following bar is above the high of that bar, so we have a gap. Same thing here, another gap here. This low, that high, another gap. A good sign of buying pressure. So if you did not buy here or here, you could simply buy at the market here, or as this bar is forming, or at the close of the bar, and put a stop below the bottom of the spike. Since you look at this and you say, yeah, it's going up, assume your probability is 60%. You therefore only need to go for a reward equal to your risk. The risk is below the bottom of the bull spike, so your stop is here. Your entry, let's say, is here. As a minimum target, you need a reward equal to your risk when the probability is 60%. So you'd look to take profits right here. And if you're afraid that the stop size is too big, just trade small. Okay? Trade half size, trade quarter size. It doesn't matter. Make sure to get some position on and use the correct stop even though it's wide. After the trend begins, you can look for pullbacks. If you're flat because you never entered, or if you're flat because you took profits, now look to enter on pullbacks. The market might be entering the channel phase of the trend. If the trend looks strong, go for a swing. If it looks weak and it looks like it's turning into a broad channel trend, go for scalps. Okay, so now we got that strong bull spike. We have a fairly deep pullback. It's 3 legs down, 1, 2, 3. You can call it a high 2. You can just say, well, it traded above here, traded above here. You have a 2-bar reversal at the moving average. Tail on top, not ideal, but it's always in long. And we have either a wedge bull flag to the moving average or a high 2 to the moving average. And we have a bull signal bar. So at a minimum, that's good for a scalp. Since the market's always in long, you can always take any position for a swing if you just use the swing stop. If you're going for a scalp, you don't want to allow pullbacks, so you'd probably put the stop below the bottom of the signal bar. The signal bar is a 2-bar reversal, so the stop would go below the lower of the 2 bars. In general, for a scalp, you're just looking for 1 push up, and you don't want to allow pullbacks. For a swing, you're expecting 2 or 3 or more legs up, and that means you do allow pullbacks. Once the trend starts to weaken, it evolves into a trading range. And when it's in the trading range phase, you buy low, you sell high, and you scalp. Eventually, there'll be a new breakout, either up or down, and then you repeat the entire process. So here's our higher low major trend reversal, and we're going up, and we're getting near the high of the day. The market gapped down from this price area on the open today. It sold off from this price area 4 bars, 5 bars into the day, and we're back into this price area again, and now we have a bear reversal bar, and it's following a high 2 buy signal. A high 2 buy signal is often the end of the trend. I don't have a trend channel line drawn in here, but this is near the top of the channel. It may be an overshoot and a reversal. It's a good location for exiting some or all of the longs, and it's probably an okay scalp for a test down to the moving average. The last pullback reached the moving average down here, so this one probably will be at least as deep as the prior ones. Pullbacks tend to get bigger as trends go on. So if you take this for a short, I would only scalp it because it's not a major trend reversal, so the market's still always in long. And if you're going to short in a bull trend, you can only go for scalps. So you'd short it, sell below this bar, get filled over here, stop above there, and go for a risk at least equal to your reward. I think the probability of this scalp is 60%. I think it's a pretty good scalp. Which type of entry is best? It doesn't matter. Okay, they all can have positive traders equations, and you can begin trading at any point in the market cycle. The trading range, the strong breakout, and the channel. It doesn't matter. There are profitable ways to trade any part of the cycle. When traders are starting out, they should be looking to swing and either taking their entire position off once their profit goal has been reached, or with experience they can maybe take half off at their first goal, which should be at least 2 times the risk, and then take out maybe another quarter at another 100% times the risk, and then let the final piece go until the end of the day. Let me give an example. Let's say the spider is in a bull trend, and let's say your usual maximum size is 300 shares. So in general, you want the scalp size to be bigger than the swing size. So the swing size might be 100 shares and the scalp size 200 shares. And the reason for that is when you're swinging, the stop often gets far away. It's often far away when you first put the trade on. In general, when you're scalping, the stop is smaller, so you can trade smaller. So you can trade larger. So in general, when traders scalp, they scalp for more shares, a larger position, than when they swing. That's not always the case. But let me just use this as an example. A trade where you're comfortable trading 300 shares and you're going to swing 100 shares and you're going to scalp the other 200. In this particular case, we have a double bottom bull flag, or a gap up and a double bottom bull flag, a very strong signal bar. So let's say you bought 1 tick above the high of the strong bull reversal bar. You would be filled right here, and you put on your usual position, 300 shares. And you're putting it on with the intention of letting 100 shares swing until there's no more reason to hold it, until there's an opposite signal, or until the end of the day, or until the market flips to always in short. And the 200 shares, you're planning on scalping out once you've reached a profit objective. Since the trend is pretty strong, you want your profit objective to be at least 2 times the risk. I would manage them. This is with experience. An experienced trader, this is how a lot of experienced traders view the market. They look to take partial profits, but if they get another signal, they'll put the scalp back on. So here's an example. Let's look at the swing side first. So if you bought your 300 shares down here, let's forget about the scalp part for the time being. You would be holding your swing part until we had the wedge top, and then we had a lower high major trend reversal setting up for a second leg down and a strong bear reversal bar, and it's right before the close. You want to get up before the close regardless, and this is a sell signal, a lower high major trend reversal after a wedge top. You should get a second leg down right before the close. So most traders would get out right here for their swing. So you bought here, you sold here, and you made 99 cents on 100 shares. So now I'm going to talk about the scalp portion. So the scalp portion, back here you bought your 300 shares, you planned on swinging 100, and at the end of the day you discovered that you get out over here with 99 cents. The scalp portion you see a very strong trend. The market is starting to accelerate upward. If you did not have time to adjust your profit target to put it higher up, maybe you'd have it at 2 times your initial risk. You would have taken off either your entire scalp here, 200 shares, for 38 cents, or maybe you would have taken half of it off, maybe 100 shares for 38 cents. If you took half off, you might take the other half off here. Buy climax, bear, inside bar, possible final flag, maybe a bigger pullback. So let's say, for argument's sake, that you took 100 shares off here at 2 times your initial risk, and the other 100 here as the market was attempting to reverse. You're still holding your 100 shares for your swing. So by right now, you just have your 100 shares for your swing. Your stop might be below the last recent bull bar, maybe below the most recent higher low, but this is a pretty minor higher low. But either one of those would make sense. So you exited out your scalp. You still have your 100 shares for your swing. Experienced traders tend to view things as 2 separate trades, the swing and the scalp. Now they got a high 2 buy, a bull inside bar for their signal bar. Many traders would put their scalp portion back on, so they'd buy back 200 shares. So now they're back up to 300 shares, which was their original position. So they're still holding their scalp, their 100 shares for their swing, and now they've added 200 shares for their scalp, and they're looking for reasons to take profit, maybe 2 times the risk. Here, that would be 18 cents. A lot of traders, if it's close to a round number, 20 cents is a popular scalp target in the spider, they would round up and try to get out at 20 cents. So they would exit their 200 shares at 20 cents and then be back to owning only 100 shares, their swing portion. And then they would look for another buy, and they might buy here. After this, they probably would stop buying for scalps because the probability is too low. And when you're scalping, you need a high probability. Whenever you're taking a scalp, you're only taking high probability setups. And if there were other good buy signals, they'd buy them and they'd scalp out. They'd buy, scalp out, buy, scalp out, and they'd continue to hold their swing. And again, the scalp signals have to be good, which means high probability. And this is the end of the module on how to trade. This is Al Brooks, and this is my price action trading course. This module is about trading major trend reversal tops. Let me first begin with a higher high major trend reversal. First, you need proper context. You need a bull trend, and then next you need a break below the bull trend line. Preferably you want enough selling pressure to reach the moving average. Finally, you want a rally that goes up to the high, here a higher high, and then a reversal down. So the context is the bull trend, the trend line break, and then the rally to the high. And the signal, which completes the setup, is a bear reversal bar. As an example of a higher high major trend reversal, I'm going to use the daily chart of PBR, Petrobras. First of all, there's a bull trend, and in this case it's a bull channel, and then there's a break below the bull trend line, and the break had good selling pressure, a number of good-sized bear bodies, and the break fell below the moving average. So the context is good so far. Next, there's a rally to a new high, maybe a double top, maybe slightly above the high, but look at the strength of the rally. We have a bull breakout and a total of 4 bull trend bars. The signal bar is either this bull bar or this 2-bar reversal. However, the tail is very big. Is it a short? Yes, but the probability is not very good because there's too much strength on this test of the bull high. You'd rather have the test be weaker than the original trend, and this test is as strong as certainly the most recent high. So to me, this is not a reliable sell signal, and it's better to wait for a second signal. The bulls see this as a double bottom, and a double bottom is a high 2 and a bull trend, and therefore they see this as a buy signal. They see this as a breakout of the high 2, and this as a probable pullback that will lead to higher prices. So the 4 bars up, these 4 bull bars with 2 of them being very large, I think that's too much buying pressure to begin to look for shorts. So it's a weak sell setup. If the bull resumes, make sure to get out. You can get out as soon as the bull trend resumes. In other words, as soon as the market goes above the high of the prior bar. You can put a stop around break even, or you can put a stop maybe above the high of your signal bar and take a small loss if the stop is hit. And this is what followed. We had a bear breakout, some follow through, another bear bar, but we're holding above the bull entry bar for the bulls who bought above the high 2 buy setup. And now we're starting to turn up. So if a person shorted below the low of this bear bar or below the low of this bull bar, we're back to around their entry price, and that's a reasonable location to exit a short, especially given that we're getting consecutive bull bars here. So I think the best thing to do, had you taken that short, is to get out with a small loss around break even. So that top failed, and we should begin the process over. We need a break below the bull trend line, we need the rally to resume, and then we need the market to turn down again around a prior high. The market accelerated to the upside. Too much buying pressure in this rally to short below this bear bar, even though it's a big bear reversal bar. The channel up is just too tight going up from here. So I would wait. We have 2 pushes down here and here. So that, in fact, is a high 2 buy setup above this bear bar. If you're looking for a top, I think it's probably better to not take the long and then reverse. I would instead wait to see if we get a sell signal before long. And we did. We have a very strong bear reversal bar. The high broke out above the top of the wedge, and we have a strong reversal bar down. So to me, this is a reasonable higher high major trend reversal setup. We broke the trend line, and we rallied to a higher high, and we're starting to get selling pressure, and the process is taking the shape of a wedge. Your initial stop is above the high of the signal bar. Your entry price is 1 tick below the low of the signal bar. Here the market looks like it gapped down below that low, so you would sell on the open. Remember, this is a daily chart. So we have a higher high major trend reversal, and within this higher high major trend reversal there's a smaller major trend reversal. You can look at this bull trend. We have a trend line break and then a rally to a new high. So there's a smaller pattern within the larger pattern. On the daily chart, I would not call this a major trend reversal. Maybe on a 60-minute chart it's a major trend reversal, but on a daily chart there are just not enough bars breaking the trend line, and the break did not go down to the moving average. On the daily chart, I would consider this to be a wedge top and higher high and a small final flag reversal. And this would be the small final flag. You could argue that this trading range is potentially a larger final flag, and it probably is on a higher time frame chart like a weekly chart. So you sold below the low of the signal bar, and we got a good entry bar, a big bear bar closing near its low, and we have good follow through. We have a bear bar on the next bar, and then we have another bear bar. We're down to the moving average, and we have a high 2 buy setup. It's still a bull trend. We're still making higher highs and lows. The market might be always in short based upon the context, the higher high major trend reversal, strong signal bar, and 4 consecutive bear bars. In my mind, I think it's always in short at this point, probably by the close of this bar. So that means I think that there'll be sellers above, and that we'll get a lower high rather than getting above the high of this bar. But the most you can be certain is 60%. At the moment, I think it's 60% certain that we'll get at least 2 legs down and at least 10 bars down. Because of the high 2, and because we're around twice the height of the signal bar, twice the size of the risk, this is a good location for taking partial profits or even full profits. Again, we're still in a higher low situation. We fell below this low, but this is not a major low. To me, this or this are more important lows. So I think we're still arguably in a bull trend, but after a wedge top, you should get two legs sideways to down. This might be the first leg down. To get a second leg, that means you need a pullback. So chances are this wedge will have a pullback, maybe to a lower high, and then a second leg down. So we should get a bounce here. You have to be ready to exit if the reversal fails. You can exit around break even, or if there appears to be a resumption of the bull trend, just get out at the market. The market is starting to trade up, and it had a lower high major trend reversal here, and it triggered. However, we started to curve up parabolically here, which is pretty good buying pressure. And now we have two small pushes down to the moving average, and the bulls will look at this as a high 2 buy setup. The bears still arguably are short with a stop above their signal bar. They might have their stop above their entry bar at this point, but I think it's probably better to, well, I don't know, I think you could argue either way. This is a pretty strong entry bar, so I think it's okay to have your stop just above it. If the market goes above it and reverses down, then you can short again. Again, we should get a second leg down, and we're channeling up. We're in a channel, and we've had 3 pushes, 1, 2, 3. So this might be a wedge lower high for a lower high major trend reversal. After higher high major trend reversals, you usually get at least 2 legs down, and you get a first leg and then a pullback to a lower high and then a second leg down, and that lower high is a lower high major trend reversal, and it's often a good location to add to a position or put on a position had you not taken the original position, or if you exited down around the moving average. So if you exit during this rally, you have to be ready to sell again, and if you're still short, you should consider selling more if we form a signal bar for a lower high major trend reversal short. Remember, you probably took partial profits around the moving average, so now you have a smaller position, and you can go back to a full position if we get another signal. Sometimes you'll have several attempts to put in a top before there's finally a major top with a big bear trend, so you have to be patient. Alright, we have a bear reversal bar in a wedge pattern, and it's a lower high, so this is a reasonable short below the low of that bar. Daily chart, it gapped down below the low of the bar. You can sell on the open of the bar as it gapped down below the signal bar, or you could wait to see if it has a bear close and then sell the close. So now we have a lower high major trend reversal after a higher high major trend reversal, and your stop at this point is above this second signal bar, the lower high major trend reversal signal bar. And this is what followed. A very strong bear spike, several big bars. This probably will result in at least a measured move down. So if you take this, the open of this series of big bear bars to the close of this bear bar and project down, it takes you down around here. A 60% chance that the market will get there, and in fact it did. 60% chance because it's a strong bear breakout, the market's always in short, and when you have a strong bear spike in a strong bear breakout, you have a 60% chance of the market reaching a measured move based on the height of the spike. So let's say you took the short, whether or not you took partial profits along the way, this would be a good location to take partial profits down here. We have a parabolic wedge, 3 pushes down, 1, 2, 3. So we have a spike and a channel, and the channel has 3 pushes. I don't have a trend channel line drawn in, but this bar would have broken below it and then reversed up. To me, this is not a strong enough bar to be looking to buy, even to buy to take profits on shorts. However, when we're starting to get more buying pressure, more bull bodies, and a strong bar like this, I think it's probably good to exit above the high of this bar. The market gapped up, I would get out on the open of this bear bar, and the bar sold off for the rest of the day. Down here, probably a good location for final profits, because now this might be a lower low major trend reversal. At this point we have a bear trend, right? I don't have the trend line drawn in, We have a break of the trend line, a test of the moving average, and now a lower low. And we have a 2-bar reversal with a bull body. So this is actually a buy signal for a lower low major trend reversal, a bottom. And since it's a buy signal, I would get out of shorts. I don't like to reverse, so I probably would not reverse. But if I was still short, I would get out of all my shorts at this point. Sometimes a spike in channel top can be followed by a major trend reversal. Remember, all channels evolve into trading ranges usually. So whenever you have a channel, you have to be ready for a possible reversal down. And then you often get a sell-off that goes all the way down to the bottom of the channel. Channels often have 3 pushes up. The spike is often the first push, and then you get a pullback, and you very often get 2 more pushes, so that you end up with a channel that has 3 pushes. Sometimes it has a wedge shape. You're looking for a breakout, a bull breakout above the top of the channel, and you want that breakout to fail, and for the market to form a bear signal bar for a reversal down. The trend down, the breakout, the reversal down, if it breaks below the bull trend line, which is the bottom of the channel, it may go down and test the moving average. If there's then a rally, preferably a weak rally, that could set up a test of the top of the bull trend. At that point, you have the context for a possible major trend reversal top. Next, you need the signal bar. You need the reversal down. Here's an example. We have a strong bull spike, probably will result in some kind of a measured move up. I don't have it marked in here, but it looks like the high is about a measured move up based on the height of the entire spike. And then after the spike, we have 3 pushes up. 1, 2, 3. You could argue that this is the first push, this is the second, and that's the third. It does not matter. In any case, there's an interesting phenomenon happening here. Look at the open of the day and then the low of the day. We had a bear trend, and the trend itself is not all that big. It's about 50 cents, about half of an average daily range in the spider. And then the market rallied strongly back up to the open of the day. If it breaks above the open of the day, it may go up for the same number of ticks that it fell below the open of the day, and if so, the market may come back and close back around the open of the day, setting up a doji bar on the daily chart. So there is resistance around a measured move up from the low of the day to the open of the day, and the market may sell off later in the day back down to the open of the day. So anyway, we have a bull channel, and we have 3 pushes up. You can draw this channel line across this high and then this high, in which case this would be a breakout above it, or you could simply draw it as a parallel of the bull trend line below, which is how I drew it here. And you can see the market poked a little bit above the line and then had a tail. And now we have a doji inside bar. So this is a possible top. As far as shorting below this this inside bar, it's still a bull trend. The market's still always in long. I think that's not a great short. And if you took that short, you'd be shorting a bull trend, and you would be doing it only for a scalp. The market sold off to the moving average. It broke below the bottom of the channel. So it's possible that if we get a test up of the high of the bull trend, we may get a major trend reversal. So the market's starting to bounce off the moving average, but look at the bounce. The bars are not that big. We have overlap. We already have a pullback. We have tails. So this rally so far is a lot weaker than this rally, and that's good. You want the rally that tests the bull high to be weak, and that increases the chances that it will fail and lead to a reversal down. You need a test of the bull high. After the resumption of the bull, which we're currently seeing, you look for a failure around the old high. The market may go to a higher high, may just double top, it may go to a lower high. It doesn't matter. You're looking for some kind of reversal down around the old high. And you also want the shape to be good. If the rally was 20 bars or more, the test of the bull high should be at least 5 to 10 bars. So if the bull trend was 20 bars or more, you want the test to be at least 5 or 10 bars. And you prefer it to be weak. You'd like it to be in two or more legs and not a strong bull spike. And you want to see some selling pressure. Small bull bodies, tails on the top, maybe an occasional bear bar, and maybe a pullback or two along the way. So here we are, we're trying to rally up, and so far we only have 4 bars in this lower high, and they're all bull bars. I would not short below this bar, even though you can argue it's a low 2. To me, we're still always in long, and I'd like to see more bars up and then a failure. This is not a convincing test of this high, and if the market comes down here, I think a lot of traders will be looking to buy this as a triangle. 1 push down, 2 pushes down, 3 pushes down. So if the setup is not quite right, you wait. You wait for a second signal, or you wait for a strong bear breakout. So you can see that some traders might argue this is a lower high major trend reversal, but it does not have enough bars, I think, in it to convince traders that this is the top. If you were trading a smaller time frame chart, like a 2-minute chart, it would have enough bars, and it probably would be a lower high major trend reversal on a 2-minute chart. But I'm trading the 5-minute chart here, and this is not a reliable sell setup. What about now? We have a micro double top, this bar and this bar, and now we have 7 bars in the pullback. So if the market falls below this bar, that would be a second signal short. I think that's a more reliable sell signal than selling below this bull bar. So that is one that I think is worth considering. Remember, most major trend reversals are low probability, usually 40 to 50% probability, and usually they don't initially trigger and always in reversal. So in other words, a top usually occurs when the market is still always in long, and it doesn't become always in short until after we get a bear breakout. To compensate for the low probability, you need to have a positive trader's equation. So if you have a low probability, you need a reward bigger than the risk. In general, you need a reward at least twice as big as the risk. So you determine your stop size and go for a profit target that's at least twice as big as your stop. So let's say you take the short below the low of this bar. Your stop probably is either above the high of the bar or above the high of the bear bar. And so now you know what your risk would be, and your reward has to be at least twice as big as your risk. So you would be looking to take profits, partial profits or full profits in this area. So the risk is 8 ticks, so you need at least 16 ticks of a reward to have a positive trader's equation when the probability is only 40 or 50%. Okay, will the market reverse to always in short if it triggers below that signal bar? Not necessarily. For it to reverse to always in short, you either need a big bear bar for your entry bar, if the context is supportive, and here the context is supportive. We have a potential lower high major trend reversal. You could also flip it to always in short if you have 2 or more consecutive strong bear bars, or if you have a strong break below the moving average. Any of these things can be enough for traders to look at the chart and say, yes, I think it's going further down. Yes, I think the market is now always in short. Again, since the probability might be as low as 40%, it might be 50%, but it's certainly not 60%. You need a reward at least 2 times greater than the risk. You can go ahead and place a buy limit order to take partial profits, maybe half off, at 2 times greater than the risk. So the target is twice as many ticks as in the protective stop. So you'd have a limit order to take partial profits here, and you would have been filled on this bar. Your initial risk is 8 ticks, 1 tick below the signal bar to 1 tick above the high of that bear bar, and that's 8 ticks. And so you'd want to take partial profits at 2 times that number, which is down here. So you'd have a limit order to take maybe half off here, and ultimately you're hoping that the market may come all the way back down to the bottom of the channel. as is often the case when you have a spike in channel. The channel usually evolves into a trading range. A trading range goes up and down. We've had the up part of the trading range, and now the bears are hoping that we get the down part, and they're hoping that it gets all the way to the bottom of the channel. At this point, if you look at this point and to the left, it's a bull trend. It's a spike and channel bull trend. However, now it's evolving into a trading range, and if we do come down here, traders will look at it as a trading range, and they'll see this bull channel as part of a trading range and not as part of a bull trend. However, it's both. It's the channel part of a spike and channel bull trend, and it's also the start of a trading range. Do you allow pullbacks? Sure. Trends have swings up and down. So that means if you're looking for a swing trade, you have to allow for some swings, some little bounces along the way. As long as the market keeps falling and forming lower highs and lower lows, the bear trend is still in effect. So if you're swing trading, you're looking for more than one leg down, and that means you have to allow a pullback. So you have a first leg down and then a pullback. You're looking for a second leg down, so there has to be a pullback, and then you get your second leg down. Sometimes the first pullback goes all the way above your entry price, so don't tighten your stop too soon. If it goes above your entry price and sells off again, then put your stop to break even, because you don't want the market to come back to your entry price a second time, because the bull trend will probably be resuming. You'd have a high 2 buy signal and a double bottom, and that would be enough to erase whatever selling that has been in effect. Okay, when you're in a bear trend, you're channeling down, stair-stepping down. Every pullback that you get, sometimes they come from very strong buy signal bars. So sometimes it looks like the trend is resuming. But remember, you're in a bear trend at this point, and bear trends often have strong-looking buy setups. The context looks good, and you get a good signal bar. That's the setup. So it's always trying to trap weak bears out of their shorts, and it also will trap weak bulls in. But in a trend, 80% of reversal attempts fail and become bear flags. So don't exit too soon. Rely on your stop and rely on your profit targets. So don't be fooled and trapped out of a good trade. Rely on your protective stop and allow the pullbacks. As long as the market's continuing to form lower highs, keep trailing your stops above the most recent lower high and trust that the trend will keep stair-stepping down. So you might take partial profits here. In fact, you should. And now look what we have. We have 2 legs down, 1 and 2, so it's a 2-legged pullback, and therefore it's a high 2 buy. Is it still a bull trend? Well, we're still making higher lows, and we have a higher high, so you could argue that it's still a bull trend, and therefore it's a high 2 and a bull trend. However, for me, this bear breakout is strong. We had confirmation on the follow-through bar, and then we had 2 more bear bars down, and now we're in a fairly tight bear channel. I personally would not buy that, and I think the odds are that we're in a bear trend and not still part of the bull trend. So for me, as strong as this 2-bar reversal appears to be, I think the odds are there'll be sellers above, and that will form a lower high and have more down. Also, we still have room down to support. So I would hold short with my stop above probably this bear bar or the top of this lower high. Again, the target is the bottom of the channel, right? We have a spike and a channel, and the market oftentimes comes back down to the bottom of the channel. Okay? This sell-off here is in such a tight channel that this bull reversal bar to me is not enough to erase the bearishness of this 4-bar bear spike. So probably sellers above, and we should get 1 more leg down. Okay, again, you often get a breakout test, and the rally often goes above the entry price, and it runs break-even stops of the weak bears who put their stops back to break-even too soon. The strong bears keep their stops above the most recent lower high, betting that the market will continue to make a series of lower highs and lower lows. In other words, that the market will continue to trend and that any reversal attempt will fail. So you can see this is testing the area of the entry price for the bears who shorted below this bar or below that bar. And I don't think it hit the break-even stop. But right now we're starting to form a potential lower high. We have two pushes up. We have a couple bull bars, and then a bear bar, and then another bull bar. So that's a small two-legged rally. Some traders may have shorted on a stop below this neckline of a potential small head and shoulders top. We have the bear breakout. Those traders certainly would not put their stops to break even, and if they did, their stops would have been hit by this rally. Bears who are assuming that the market's in a bear trend, a bear channel, they're assuming that any rally attempt will fail. So what are they going to do? The aggressive ones will sell the closes of strong bear bars, strong bull bars, and then put a stop above the most recent high or low, betting that any rally attempt will fail and result in a lower high. More conservative traders, they'll look for setups like this. A pullback to the moving average, a low 1 or a low 2 short. They'll short either below this bull bar for the low 2, or they'll short below that bear bar. Traders who took profits over here, they may put a scalp on here and hold their swing trade. So they hold the swing trade until the market stops trending, and they keep taking scalps along the way, in addition to their swing trade. Once the bear resumes, traders lower their protective stops. Either they just put them down to break even and allow bigger pullbacks, or they lower their stops to above the most recent lower high. Most traders will not let the market come back to their entry price a second time, right? They'll allow one test, but once the trend resumes again, they will not let the market come back and hit their entry price a second time. They'll get out at break even. All right, so the market tried to pull back here and reverse up, but instead we got a double top with this bar and that bar. And this bar, the high of this bar, as strong as the bar is, it stayed below this bar and it did not hit the break-even stops. So at this point, arguably, this is a decent swing short for a double top bear flag and a bear trend. So traders would place sell stops one tick below the low of this bull bar, with protective stops one tick above. Probability, I think, is not all that high because we're near the bottom of a potential trading range. So traders probably should initially plan to go for a reward 2 times their risk. Once the move starts down, they can adjust their target based upon actual risk instead of initial risk. Again, remember I told you that the market might come down and test the open of the day. And that's what we're doing. So is this bear bar the start of a new bear trend, or is it simply a sell vacuum testing support? Support of the open of the day and support of the bottom of the channel. At this point, we do not know. This is not good. If you're looking for a bear breakout, you want to see a second bear bar. Like here, you got a bear breakout and you got another bear bar. You don't want to see a bear breakout and then a bull bar, right? To me, that's not good for the bears. To me, I would consider taking profits right around the open, especially since we're getting some buying pressure at that support level. And I would also consider taking partial or full profits around the bottom of the channel. So I think it would be okay to take partial swing profits or full swing profits down here. As far as the bears who shorted as the market fell below the low of this bar, their actual risk probably was very small. We don't know how much this bar pulled back. It's possible it went below the bar and then traded all the way up to the top of the bar and then traded down again. So the actual risk might be above the high of this bear bar. I don't know. But if I had shorted below this bar and then I saw this bull bar, I would be pretty quick to take profits, either above its high or if we start to stall out here before it reaches a target. Okay, next I'm going to talk about a major trend reversal in the bond futures using a daily chart in a bull trend. Bond futures clearly in a very strong bull trend, and then we had a triangle late in the bull trend, and then a very strong breakout. This could end up being an exhaustive buy climax and the top of the bull, and this triangle might end up being the final flag of the bull trend. We had a big move up, and now we have a pretty big move down. Big up, big down, big confusion, usually the market goes sideways, and that's what it did. It went sideways enough to break below the bull trend line. I don't have the trend line drawn, but it's something like this. So we have a sell-off, and it broke below the bear trend line, and it also broke below the moving average. At this point, we don't know if the market is topping out or if it's forming a base for another leg up, right? Whenever you have a tight trading range, it becomes a 50-50 market. Equal chance of a resumption of the trend, equal chance of a reversal and a sell-off. So here is the trend line, and the market fell below the trend line, and it fell below the moving average, although it's continuing to find buyers at the moving average. See how the closes are all above the moving average? When we got a close below, it immediately reversed up. Close below, immediately reversed up. Tight trading range. So a tight trading range in a bull trend is often the final flag of the bull trend. So to me, at the moment, I would do nothing. But if we do get an upside breakout, I would start looking for a major trend reversal and for a turn down, first back into the tight trading range and then possibly below. At the moment, too much buying pressure. The market is having a hard time closing below the moving average. So if there's a weak major trend reversal signal, it's probably better to wait. If there are too many consecutive bull bars, for example, in the test of the old bull high, or if there's a weak signal bar, or if the rally is in the form of a bull microchannel, that's all too much buying pressure, and I would not take the short signal. I would wait for a second signal or a stronger signal. And look what we had. We had an II pattern, a breakout mode pattern, after a 2-bar reversal. We have a little bull breakout here, and we have follow-through, so the market's going at least a little higher. But now we have a pause bar here, and then we have a bear bar here. Possible lower high major trend reversal, but a bull signal bar, which I don't like. So whenever the setup, the context is not perfect, and here it's not, we have too much buying pressure in this leg up. If the context is not perfect, I need a perfect signal bar. And to me, this is not a perfect signal bar. We have 11 consecutive bars up in this bull microchannel, and that's just too much buying pressure. So I would need a very strong signal bar, and we don't have one. So I would not take that short. Instead, I would wait. And this is what happened. The market broke below the bull microchannel, triggering the lower high major trend reversal, but I would not take that short. With these 2 pushes down here, up and down, it's a high 2 bull flag. It's also a triangle, 3 pushes down, 1, 2, 3. Swing bull traders can take this for a leg up. I would be hesitant to do that because we have a tight trading range, and that's a very strong magnet, and I suspect that any rally we get in here is going to come back to this tight trading range before we go very high, much higher. So would I take this buy and then look to short? Since I expect the market's going to come back here, I would not. Whenever I think the market's going to go down and I have a possible buy in the meantime, I usually don't take the buy and instead just wait to see if I get my sell signal. Okay, here we have a second entry short. We had the reversal bar here, but a bull body, not good. We had reversal here, but a bull body, not good. Here we have a bear body and arguably a wedge higher high. We're above the prior high, and we have 3 pushes up. 1 push here, 2 pushes here, and 3 pushes there. Or you could say this is the first push, second push, and third push. In any case, it looks like this might function as a wedge higher high major trend reversal, and I think that's probably an okay short because we have a bear signal bar and we have a second entry. What's the probability? Doesn't matter. It's at least 40 or 50%, and the context is good. So we have good context and a decent signal bar, a bear body, and that is an okay short. Additional evidence: whenever you're looking to take a trade, always look for additional reasons. Like a wedge top, a measured move, a second signal, a bear signal bar. Well, we have a second signal and we have a bear signal bar. But is there also a measured move where we are? Is there also a wedge top? I mentioned that there might be a wedge top. Okay? In fact, you can draw a wedge pattern in here with these pink lines. And a tight trading range is a trading range, and trading ranges often lead to measured moves. So if you look at the bottom of the range to the top of the range and project up, that's exactly where the market's starting to fail. We poked a little bit above the measured move target. We poked a little bit above the trend channel line, and now we have a bear signal bar. So this increases the chances that this will be a successful wedge, higher high, major trend reversal at a resistance level, the top of a channel, and at a measured move target. If you take the trade, you sell one tick below the signal bar, and your initial stop is one tick above the signal bar. At this point, this is a daily chart. The bar is 31 ticks tall, so your initial risk is 33 ticks, 2 ticks more, because you entered one tick below, and your stop is one tick above. So look what followed 2 bars after the second bar after the entry. We have a very big bear bar, but there's something special about this bear bar. It's a breakout bar, obviously. Its close is below the low of the moving average. Its close is below the low of the prior bar. So there's a big gap between the close and the low of the prior bar. But the close is also below this low and below all of these bars as well. So this bear bar is reversing the lows of the past 10 bars or so and the closes of the past 10 bars or so. So all the traders who bought in here are now holding losing positions. So this is a very important sell signal bar, and chances are the traders who bought in here will look for any rally to exit, so there should be sellers on any pullback. And this is what happened. We had the big bear breakout bar, but followed by a bull inside bar. Not good for the bears. You always prefer a series of strong bear bars. You don't want a strong bear breakout bar followed by a bull bar. The bulls will argue that this is just a high 2 legs down, 1, 2. So a double bottom, 1, 2, and a buy signal. To me, I think it's still on the higher high major trend reversal sell. You could lower your stop to just above the high of the bear bar if you wanted, but I think technically it's probably better to keep it above the high of the signal bar until after the trend resumes down. So the failed bear breakout resulted in a doji bar, not good for the bulls, and then another bear bar, and then we have a second push up. So technically this is a low 2 short below the low of that big outside up bar, but 5 sideways bars, I would not take that short. However, I would hold short and probably lower my stop to just above the high of this lower high. Okay, so what do you do down here? We're back down to the low of the tight trading range, and now we have a reversal bar, a doji body, not strong, but this is pretty much 3 little pushes down. We went down here and then up on this bull bar, and then down again, and then sideways, and down again. So there's a small wedge bottom here, a large high 2 buy, 1 leg down here on this big bear bar, another leg down, and we're at the bottom of a trading range. So from right around this area to over here, we're in a trading range, and now we're at the bottom. We did not get sustained selling after the bear breakout, so rather than this turning into a strong bear trend, it appears that it's transitioning into a trading range. So to me, since this is arguably a buy signal, double bottom at the bottom of a trading range, I would at least exit part and maybe all of my short. And if I'm wrong and the trend resumes down, I look to short again. I personally would not reverse. An aggressive bull could buy here, a test of the bottom of a developing trading range. I personally probably would wait for a second signal before buying. If you only exited part of your position and you're continuing to swing, your stop is below the most recent lower high. So your swing stop at this point is right here. Final profits. Anytime you see a strong buy signal, you take final profits on your shorts. What's a strong buy signal? Maybe a measured move down to a wedge bottom, maybe a micro double bottom, if the location is good, bottom of a trading range. And look what we got here. We had one more push down, and now a bigger wedge, but here we have an inside bar, a bull inside bar. The market broke to the downside, but instead of continuing down, we reversed slightly, and now we have 3 bars with tails on the bottom. So we're trying to break out of the bottom of the wedge, and instead, every time we try, we reverse up with a tail. So to me, I would get out of any shorts above the high of this bar. Too much risk of a pullback, maybe to the top of the channel. We have a spike down, a pullback, and a bear channel with 3 pushes down. 1, 2, 3. So we may have a rally back up to the top of the channel. So if I took shorts, I personally would get out. Too much risk that the channel down will transition into a trading range. And I want to buy low and sell high. And since I'm short, I'm looking to buy. So I want to buy back here. I don't want to buy back way up here. Okay, I'm going to go through the same slides, slide by slide, with no marks on the chart. And I'm not going to say anything, just so that you can look at the chart bar by bar. And that is the end of the module on trading major trend reversal tops.